Hello and welcome back. This is the 10th segment in our educational series. And let me first thank you wholeheartedly for sticking with me and sharing with me your most valuable resource, which is your time. When we consider real estate investments, we normally look at the net present value or the internal rate of return as our main financial decision-making tools. However, I'm here to tell you that there is one more tool in our bag, and that is the accumulation of wealth or capital accumulation for us to consider when we make our financial decisions in real estate. I'm your host, Brian Shakarami, and let's get started. Our topic of discussion in this segment is capital accumulation. What is it? How it's used, why we use it, and how we evaluate it. All your commercial real estate decisions demand you to make some financial choices. Up to now, we've made these choices using the net present value or the internal rate of return, the NPV or the IRR. Is there any other decision-making alternative out there? And if there is, why should we consider it? Why should we use it? After all, the IRR has traditionally been our main method of comparing our investment alternatives. We simply want to know what the rate of return is, or the IRR. But the problem is IRR has a whole bunch of limitations, so therefore it has some problems. And these problems come in at least 5 folds. First is the kind disparity. Second is the size disparity. Third is the time disparity. Fourth is the issue with the reinvestment of the cash flows. And last is the issue with negative cash flows. I'm sure you've heard the saying that you must compare apples and apples. It is wrong to compare apples and oranges. By the same token, it is wrong to compare a real estate investment and a mutual fund or stocks and bonds. At least through the eyes of the internal rate of return or the IRR, it is wrong. These investments are like apples and oranges. They're different. If you have different size investments requiring different initial capitalization, then the IRR is not your proper method of decision making. If you have different holding periods for different investments, then the IRR is not the best method to use for your investment decision making. You know, commercial real estate investments generally have rental income in the form of monthly or annual cash flows. How do you account for these cash flows? How, where, and when, and at what rate do you reinvest them? If you have a major expenditure, let's say roof and or HVAC, which eats into your positive cash flow and then some, forcing you to inject capital into your property to resolve the issue, which may result in a negative cash flow. How do you account for that? These are the Achilles heel of the internal rate of return, or the IRR. They're factors that the IRR just cannot account for, and therefore its limitations. So then, exactly what does the IRR measure? Here's the kicker. The IRR, the internal rate of return, measures your dollars in the investment while they're sitting in the investment. That means while it's sitting in the building. So the question is, what does the IRR not measure? Exactly what we just discussed. All the external factors, such as kind disparity, size disparity, time disparity, reinvestment of the cash flows, and finally the negative cash flows. The IRR just does not measure these well. The IRR is the wrong tool to use for them. So that being the case, what do you do? How do you overcome this issue? Where do you go? How do you resolve it? I say by thinking like a U.S. Marine, which means that you improvise, you adapt, and you overcome. That was really nice, but exactly how do you do it? How do you go about it? This is where the capital accumulation method enters the scene. It basically enables us to compare different investment alternatives, not through the eyes of the IRR or the internal rate of return, but through their capital appreciation or the growth of their capital. What a concept. growth of capital. That's something everyone's looking for. And the best thing about it is that this method can make adjustments for all the external factors that we just talked about. It eliminates all your real estate investment cash flows by projecting them into the future using a reinvestment rate to the disposition year, and then combines it with the disposition price to give you your accumulated capital. Hence the phrase capital accumulation. So for comparison purposes, at the end, all you have is nothing but your initial investment and your proceed at the end. And this proceed is your capital accumulation. Once you have an initial investment and your accumulated capital, then it would be easy for you to figure out what the growth rate of this capital is from a percentage standpoint, as opposed to using the internal rate of return. So in summary, we'll have two things here. One, the capital accumulation, and two, the growth rate of our capital, or GRC. As always, let's drive our point home or our points home with an example. Our example looks at two different investments, and they are literally totally different. Investment one being a real estate investment with its associated initial investment, cash flows, and sale proceed at the end. Investment two could be a stock, bond, mutual fund, or an investment of a different kind, other than the real estate. So here's our example. Investment one, being a real estate investment, requires an initial investment, has some associated cash flows, some are negative, and has a sale price at the end of 4 years. Investment two is an investment of a different kind, initial capitalization of $330,000, and the proceeds at the end, $531,468. So what's the problem here? The problem is that we are not comparing apples and apples. We're comparing apples and oranges. Everything is different here. And when I say everything, this everything starts with the initial investment capital. Investment one has $300,000, investment two has $330,000. So investment two has $30,000 more in initial investment than investment one. Our second problem is our time disparity. Investment one has a 4-year time period, but investment two has a 5-year time period. They're not equal. Again, apples and oranges, not apples and apples. There is a disparity in the cash flow. Investment one obviously has some cash flows, but investment two has no cash flows. How do you account for that? Investment one has a negative cash flow. How do you account for that? Investment one is totally different than investment two. So you cannot do a like-kind exchange per the IRS's ruling. They're apples and oranges. So as we can see, everything about these two investments are different. The only thing that's the same is that they both have an internal rate of return of 10%. Investment one has an IRR of 10%. Investment two has an IRR of 10%. How do we tackle this problem? Remember, I said that this is an iterative process of equalization, forcing a conformation into a certain look that allows us to compare apples and oranges. This conformation basically starts with the equalization of cash flows. To conform, we must get rid of all our cash flows, positive or negative. Positive cash flows are projected forward into the future to the disposition year or the year of sale, 1 year at a time, using our reinvestment rate. Negative cash flows, on the other hand, are projected backwards in time to the year before, added to the previous year's cash flow to ensure that a positive cash flow is obtained. The resulting cash flow is then projected into the future, again 1 year at a time, using our market reinvestment rate until the disposition. The final projections are added to the price of sale to give us our capital accumulation. From there, we equalize for timing by projecting into the future. And after we equalized our timing, we equalize the initial investment. So let's get started. We'll start with the equalization of our cash flows. If you look, we have cash flows in investment 1, but nothing in investment 2. This is where we want to be in terms of looks for investment 1. We want to have zeros here and a final price and no cash flows. And this is how we want to look. Initial investment, capital accumulation, zero in between. But to do our analysis, we must have a reinvestment rate, of course, for our cash flows. For our understanding, since the IRR, or the internal rate of return for both investments, are at 10%, we'll consider 3 scenarios involving 3 reinvestment rates. We'll obviously consider our 10% internal rate of return as an anchor rate. However, we'll consider 2 other reinvestment rates, one below the 10% or 9% and one above the 10% or 11%. We'll then go through the iterative process to equalize and conform each scenario, and at the end we'll compare the capital accumulation of our 3 scenarios against investment 2, and may the best one win. So to recap, we will do this confirmation process for scenario 1 using a 10% reinvestment rate, which incidentally is the same as our internal rate of return. For scenario 2, we will consider the same, but with a 9% reinvestment rate. And for scenario 3, we will consider the same using an 11% reinvestment rate. To make it flow better, I will start with the reinvestment rate of 9%, then go to 10%, then go to 11%. For this reason, we will start with scenario 2, with a market reinvestment rate of 9%. We'll start with the equalization of our cash flows as follows. Looking at the cash flows, we see that on year 2, we have a negative cash flow. This negative cash flow must be projected backwards in time to year 1, right here, at a market reinvestment rate of 9%. Added to year 1 cash flow and then projected back into the future, which sounds like an old movie, 1 year at a time at the reinvestment rate of 9%, until the 4th and final year, each time combined with the annual cash flow of each year, and finally combined with the sale price. And lo and behold, we end up with our accumulated capital. So again, we take this negative cash flow, we project it back in time at a 9% discount rate, and we end up with $24,771. This is negative. Added to the cash flow of year 1, we end up with $5,229. This is what we project forward 1 year at a time into the future using a market reinvestment rate of 9%. And then we end up projecting the year 2 of $5,700 into the future again at a 9% rate, which would give us $6,213. And we add this $6,213 to the year 3's annual cash flow, and lo and behold, we have $51,213, for which we are going to project into the future at a rate of 9%, which gives us $55,822. This is then added to the annual cash flow of year 4 and the disposition sale to give us the accumulated capital. And once we have the accumulated capital, we can then figure out a growth rate for this capital. In this case, it was 9.94%. So now we've conformed the cash flows into a look that we were after. We have initial investment and we have a final sale price, and we have no positive or negative cash flows in between. So here's a comparison summary of what we just did. But there is a problem here. We're still not comparing apples and apples. We're still comparing apples and oranges. We must make some adjustments and equalize our timing. So what do I mean by that? Investment 1 is for 4 years, investment 2 is for 5 years. Again, they're apples and oranges. They have to be the same. They both have to be 5 years. So there is a timing disparity here that we have to fix. And this is a really easy fix. because all we have to do is to project our accumulated capital at year 4, 1 year into the future, at our reinvestment rate to arrive at our accumulated capital at year 5. So projecting this accumulated capital 1 year into the future at a 9% rate gives us our final capital accumulation of $477,662. Here's one more comparison of investment 1 and investment 2. But we still have a problem here because we are still not comparing apples and apples. We are still comparing apples and oranges. Why? Our initial investments are different. Investment 2 has a $30,000 higher initial investment, hence apples and oranges. To resolve this issue, we have to consider our problem differently. We have to look at it differently. We have to change our perspective. So what do I mean by that? Consider this. What if we took the $330,000 initial investment for investment 2 and we placed $300,000 of it in investment 1 and we reinvested the rest, which is the additional $30,000 at a market rate or our reinvestment rate of 9%. What if we then combine the two? What do I mean? Good question. Here we go. Out of the $330,000, we take $300,000 and put it in investment 1. Then we take the other $30,000 and we invest it in the market at an investment rate of 9% for 5 years. And at the end of that 5 years, we get $46,159. Now we can combine the two investments. So when we combine the two, our initial investment of $300,000 and $30,000 gives us $330,000 initial investment. And we combine the accumulated capital of investment 1 with the accumulated capital of our market investment. And we arrive at a total capital accumulation of $523,821, which gives us an annual growth rate of 9.67%. How about that? In summary, we see that if we were to split our money, put part of it in investment 1 and part of it in a market investment, our capital accumulation would be $523,821. This, of course, is at a market reinvestment rate of 9%, as opposed to the capital accumulation of $531,468 if we had just placed all the money in investment 2. In our universe, everything is relative. We measure everything relative to something else. Something on its own has no relativity. If I'm number 1, 2, or 3 in a marathon, this is hopefully compared to at least 50 other people in the race. By the same token, we are comparing our capital for investment 2 versus breaking the same capital and placing it in investment 1 and then reinvesting its remainder in the market at a market rate of 9%. It's a no-brainer. Investment 2 is clearly the winner here. But here's the kicker. This win is totally dependent and related to what the market reinvestment rate is. The reinvestment rate here is a game changer. So for this changing of the game, let's look at scenarios 1 and 3 to gain a better understanding of what we just talked about. We will start with scenario 1. Market reinvestment rate of 10%. As before, we'll start by equalizing the cash flows and conforming it to the form that we want. We do the same thing we did under a 9% market reinvestment rate, and lo and behold, our accumulated capital at the end of year 4 is $439,160. And our capital rate of growth is 10%. And this is our investment conformed for 4 years. Initial investment, accumulated capital. Now we take this and we have to make adjustments for time disparity. And we easily do this by projecting the accumulated capital at year 4, 1 year into the future at an investment rate of 10%, which gives us $487,468. Now we must equalize the initial investment to conform to our form and be able to compare apples and apples. We'll start with our initial investment capital of $330,000 for investment 2. We'll place $300,000 in investment 1 and we'll market reinvest the remaining $30,000 at a reinvestment rate of 10% for 5 years, which will give us $48,315 at the end of 5 years. Now we will combine the two. Our combination investment at a market reinvestment rate of 10% gives us a total capital accumulation of $535,783. This gives us an annual growth rate for our capital of 10.18%. Comparing this to investment 2 by itself, we see that our capital accumulation is now higher than the capital accumulation for investment 2. So what happened here? Investment 1 is clearly the winner, but that's because the reinvestment rate changed to 10%. Now let's look at scenario 3. All being the same, the only thing that's changed is the market reinvestment rate being 11%. We'll go through the iterations again. We'll start with the equalization of our cash flows, and we come up with the accumulated capital at the end of year 4, giving us a capital growth rate of 10.06%. In summary, this is our conformation look. We will then work to equalize the timing disparity. This is easily done by projecting the accumulated capital for year 4, 1 year into the future to year 5 at a market reinvestment rate of 11%. And that gives us $488,524. Now we must equalize them for initial investment. Again, we'll start with our initial investment capital of $330,000 for investment 2. We'll place $300,000 in investment 1 and we'll market reinvest the remaining $30,000 at the reinvestment rate of 11%. At the end of 5 years, this gives us an accumulated capital of $50,552. Now we combine the two. Our combination investment here in the green gives us a total capital accumulation of $539,076. And that gives us an annual growth rate of 10.31%. Comparing this to investment 2, we can clearly see that our combination investment has a higher accumulated capital than investment 2 by itself. I want to emphasize that this is using a market reinvestment rate of 11%. So again, if we had an 11% reinvestment rate for our capital, clearly investment 1 would be the choice. So in summary, the size of our capital accumulation really depends on the market reinvestment rate. Very important to note. Here's a synopsis of investment 1 under various scenarios with a 9%, 10%, and 11% reinvestment rate. And of course, we have the accumulated capital or capitalization for investment 2. Here, it is easy to see that if we have a reinvestment rate above 9%, meaning like 10 or 11, it is much better to do investment 1 rather than investment 2. So in a nutshell, capital accumulation considers external factors such as reinvestment rates under consideration. That's something that the internal rate of return just does not do. In summary, we just covered the shortfalls of the internal rate of return, or IRR. We also covered capital accumulation, what it is, where and how it's used, and what its advantages are. As always, if you have any questions regarding what we just discussed, please send me an email to the following link, and I would be happy to get back to you. Thank you for your time.